On December 31st, 2025, the Federal Reserve Bank of New York published its quarterly household debt report. It's a dense 47-page document filled with charts, tables, and economic jargon that most Americans will never read. On page 14, buried in Table 3, is a number that should terrify anyone paying attention to consumer financial health. Total U.S. credit card debt, $1.13 trillion. That's not a typo, $1.13 trillion in credit card balances. To put that in perspective, that's more than the GDP of Mexico. It's more than the combined market capitalization of Walmart, Coca-Cola, and Disney. And it's growing at the fastest rate since 2008. But here's what makes this different from past credit cycles. The average credit card interest rate is now 21.47%, the highest on record. Delinquency rates are climbing. And unlike 2008, when the crisis was concentrated in housing, this crisis is spread across 191 million American cardholders. Disclaimer: this analysis examines consumer debt data and historical credit cycles. Economic outcomes depend on employment trends, Federal Reserve policy, and consumer behavior that are inherently unpredictable. This is educational content, not financial advice. Consult qualified professionals for personal financial decisions. Now let's understand how we got here, and what happens when America's consumer spending engine runs on borrowed time. The current situation. Credit card debt crossing $1 trillion isn't just a big number, it's a fundamental shift in household financial stability. According to the Federal Reserve data from Q4 2025, total credit card debt, $1.13 trillion average balance per cardholder, 65101 risk dollar cardholders. Carrying balances, 173 million Americans. Average interest rate, 21.47%, up from 16.3% in 2021. Delinquency rate, 90 plus days past due, 3.89%, up from 2.1% in 2021. Let me break down what this means in real terms. If you're carrying the average balance of $6,501 at the average rate of 21.47%, and you make only the minimum payment of 2% monthly, $130, here's what happens. Time to pay off, 22 years and 7 months. Total interest paid, $12,947. Total amount paid, $19,448 for a $6,501 balance. You'll pay nearly 3 times what you originally borrowed. And that assumes you never add another dollar to the balance, which most people do. This isn't a small subset of irresponsible spenders. This is 173 million Americans, 54% of all adults carrying revolving credit card debt month to month. How we got here? The path to $1.13 trillion in credit card debt wasn't an accident. It was the result of 3 converging forces. Force 1, real wage stagnation. According to Bureau of Labor Statistics data, real wages adjusted for inflation, have fallen 2.3% since January 2020. Translation: your paycheck might say a bigger number, but it buys less than it did 5 years ago. Meanwhile, the cost of essentials has exploded. Groceries, up 23% since 2020. Gasoline, up 41% since 2020. Rent, up 28% since 2020. Auto insurance, up 37% since 2020. Electricity, up 19% since 2020. When your income is flat, but your expenses rise 20-40%, there are only 2 options: cut spending or borrow. Millions of Americans chose borrowing. Force 2, the COVID stimulus hangover. In 2020 and 2021, the federal government injected $5 trillion into the economy through stimulus checks, expanded unemployment, child tax credits, and student loan forbearance. Credit card balances actually fell in 2020 and 2021. People paid down debt with stimulus money, but those programs ended. Student loan payments resumed in October 2023. Expanded child tax credits expired. Pandemic savings were depleted. A study by the San Francisco Federal Reserve found that by June 2024, the median household had exhausted all excess pandemic savings. They were back to living paycheck to paycheck. Or worse. Force 3, the interest rate shock. In March 2022, the Federal Reserve began raising interest rates at the fastest pace in 40 years. The overnight rate went from 0.25% to 5.5%. Credit card rates are variable, tied to the Fed's rate. When the Fed raised rates, card rates followed immediately. In 2021, the average credit card APR was 16.3%. By December 2025, it was 21.47%. If you were carrying a $10,000 balance, your annual interest cost jumped from $1,930 to $2,147, an extra $507 per year just in interest. For millions of Americans already struggling with inflation, this was the breaking point. The delinquency wave. Here's where the crisis becomes visible. According to Federal Reserve data, The credit card delinquency rate, the percentage of balances that are 90 plus days past due, has risen from 2.1% in Q4 2021 to 3.89% in Q4 2025. That might sound small, but it represents $43.9 billion in seriously delinquent debt, money that borrowers cannot pay. And delinquency is a lagging indicator. It measures what's already failed. The leading indicator is the current but stressed category, borrowers who are making minimum payments but barely surviving. A TransUnion study from October 2025 found that 28% of credit card holders reported struggling to make minimum payments. That's 48 million Americans, one unexpected expense away from delinquency. What's the unexpected expense? Car repair, $1,200 average. Medical bill, $2,400 average for ER visit. Job loss, average time to new job is 5.5 months. Home repair, $3,800 average. Any of these pushes a stressed borrower into default. Historical precedent, the 2008 credit card crisis. We've seen this pattern before. In 2008-2009, credit card delinquency rates spiked to 6.77%, the highest on record. Credit card charge-offs, debt written off as uncollectible, hit $89 billion in 2009. What happened? The recession destroyed jobs. Unemployment hit 10%. People couldn't pay their cards. Banks stopped lending. Credit limits were slashed. The credit contraction deepened the recession. But here's the critical difference. In 2008, total credit card debt was $865 billion. Today, it's $1.13 trillion, 31% higher. In 2008, the average interest rate was 13.4%. Today, it's 21.47%, 60% higher. In 2008, household debt to income ratio was 130%. Today, it's 104%, actually better on this metric. So we have more absolute debt, much higher interest rates, but lower debt to income. What does that mean? It means households are less leveraged overall, good, but the debt they do carry is far more expensive, bad. And with real wages falling, the servicing burden feels heavier, even though the ratio looks manageable. The credit card business model. To understand where this goes, you need to understand how credit card companies make money. Revenue source. 1. Interest. If you carry a balance, you pay interest. At $1.13 trillion in balances and 21.47% average rate, credit card companies are earning approximately $243 billion per year in interest income. That's pure profit on money they created by extending credit. Revenue source 2. Fees. Late fees, over-limit fees, annual fees, cash advance fees, foreign transaction fees. The Consumer Financial Protection Bureau estimates Americans pay $12 billion annually in credit card fees. Revenue source 3. Merchant fees. Every time you swipe your card, the merchant pays 2 to 3% to the card network. On $4.7 trillion in annual credit card transactions, that's $141 billion in merchant fees. Total credit card industry revenue, approximately $350 billion per year. But here's the vulnerability. This model requires cardholders to keep borrowing and paying. If delinquencies spike above 6 to 7%, if charge-offs exceed 10%, if cardholders stop spending, the entire model breaks. What happens when people stop paying? Let's walk through the cascade. Step 1, rising delinquencies. We're already here. Delinquency rates are rising, banks increase loan loss reserves, money set aside to cover expected defaults. Step 2, credit tightening. Banks reduce credit limits, they deny new applications, they close inactive accounts. This happened in 2008. $2.5 trillion in available credit was pulled from the market. When credit limits drop, credit utilization ratios rise, same balance, lower limit. This damages credit scores, triggering penalty interest rates. Step 3, spending collapse. Americans spend $4.7 trillion annually on credit cards, 28% of all consumer spending. If credit availability contracts by even 10%, that's $470 billion less in consumer spending. Retailers suffer, layoffs begin, unemployment rises. Step 4, recession feedback loop. Job losses, more delinquencies, more credit tightening, less spending, or more job losses. This is the 2008 pattern. Step 5, bank losses. In 2009, credit card charge-offs hit $89 billion. Banks like Citigroup and Bank of America took massive losses. Government intervention, TARP, was required. Today, with $1.13 trillion outstanding, a 2008 level crisis would produce approximately $116 billion in charge-offs. Most large banks can absorb this, but regional banks with concentrated credit card portfolios face serious risk. 4 scenarios. Scenario 1, Soft landing Fed cuts rates in 2026. Credit card APRs fall to 18%. Unemployment stays below 4.5%. Real wages recover as inflation normalizes. Delinquency rates stabilize around 4 to 5%. Some borrowers struggle, but no systemic crisis. Credit availability remains stable. Probability, moderate. Requires economic conditions to improve. Historical parallel, 2015-2019 period of stable consumer credit. Scenario 2. Managed deterioration recession hits in late 2026. Unemployment rises to 6%. Delinquencies climb to 6.7%. Banks tighten credit moderately. Some regional lenders fail. Government intervention limited to FDIC resolution of failed banks. Recession is shallow, 6 to 9 months. Probability, moderate. Most likely a Fed cuts too slowly. Historical parallel, 1990-1991 recession, painful but short. Scenario 3, credit contraction. Crisis, deep recession. Unemployment hits 8 to 9%. Delinquencies spike above 8%. Banks pull $1 trillion plus in available credit. Consumer spending collapses. Major credit card lenders take heavy losses. Government bailout required for some banks. Probability, low to moderate. Requires policy mistakes and external shocks. Historical parallel, 2008 to 2009 severity. Scenario 4, consumer debt jubilee. Political pressure mounts for debt forgiveness. Government implements partial credit card debt cancellation similar to student loan forgiveness attempts. Banks take massive losses. Moral hazard concerns. Inflation impact unclear. Probability, very low. Politically unlikely given composition of Congress. Legal challenges, certain. Historical parallel. No modern precedent in U.S. Biblical jubilees, but not relevant here. Go-to gets hurt. The pain is concentrated but widespread. Cardholders. Those carrying balances at 21% rates are paying $2,147 per year on a $10,000 balance just in interest. If delinquent, credit scores destroyed for 7 years. Credit card companies. Charge-offs destroy profitability. Stock prices of Discover, Capital One, Synchrony fall sharply during crises. Retailers. Consumer spending decline hits revenue. Layoffs necessary. Stock prices fall. Workers, retail, hospitality, service sectors most vulnerable to spending-driven layoffs. Who's protected? Bank depositors. FDIC insurance protects deposits, even if credit card losses hurt bank profitability. Cash-based consumers. Those who pay cards in full monthly or use debit cash are not vulnerable to rate hikes or credit contraction. Defensive sector workers. Healthcare utilities. Government jobs, less vulnerable to consumer spending cycles. The bottom line. $1.13 trillion in credit card debt at 21.47% interest with rising delinquencies is not sustainable indefinitely. Something must give. Either incomes rise, interest rates fall, spending falls, or defaults rise. The most likely path is a combination. Fed rate cuts in 2026 will help. If recession is avoided and real wages recover, this stabilizes at elevated but manageable levels. But the margin for error is thin. Any significant economic shock, job losses, another inflation spike, geopolitical crisis, could tip this into 2 to the 8 level credit crisis. For individuals, the message is clear. If you're carrying high interest credit card debt, paying it down is the highest return investment you can make. A 21% guaranteed return, the interest you avoid, beats any stock market expectation. For the economy, the message is equally clear. Consumer spending drives 68% of GDP. That spending increasingly runs on credit. When credit tightens, recessions follow. The $1.13 trillion credit card bomb isn't ticking loudly yet, but it's ticking. Subscribe for ongoing analysis of consumer debt, credit markets, and economic risk. We track the numbers that matter before they become headlines. Thanks for watching.